Have you ever imagined waking up every day knowing that you'll never have to work to pay the bills again? That your money works for you, generating automatic income month after month? If you already invest but still don't know exactly how much you need to accumulate to live exclusively off dividends, this video will show you a clear and strategic plan. We'll talk about the safe withdrawal rate, how to calculate your financial independence, and how to build a portfolio that covers all your expenses for the rest of your life. If you're between 35 and 55 years old and already have built some wealth but want to ensure that your money lasts forever, this content is essential for you. Imagine no longer depending on your job, having complete freedom to choose how to live. But be careful. Most people make fatal mistakes in this process and end up running out of money too soon. Stay with me until the end, because today you'll learn how to create a lifetime income with dividends without ever having to work again. The biggest mistake people make when trying to live off passive income is thinking they need millions to achieve this goal. The truth is, with the right strategy, it's possible to reach financial independence much sooner than most people imagine. But then another problem arises. Without a well-structured plan, many investors end up depleting their assets incorrectly or making withdrawals that are unsustainable in the long term. In this video, I'll show you how to avoid these mistakes and ensure that you can live comfortably just from the dividends of your portfolio. I'll present practical examples, case studies, and strategies so you can calculate exactly how much you need to never depend on a job again. To understand how to live off dividends, you need to know an essential concept: the safe withdrawal rate, SWR. This is a percentage of your assets that you can withdraw each year without compromising your capital in the long run. The most well-known rule for this is the 4% rule, which suggests that by withdrawing only this percentage from your portfolio annually, your money should last for the rest of your life. But does this rule apply to any scenario? The reality in Brazil, for example, has higher inflation and a more volatile economy compared to markets like the United States. That's why it's crucial to adapt this concept to our reality. The first step is calculating the amount needed to live solely off dividends. If you need 10,000 Brazilian reals per month to cover your expenses, that means 120,000 Brazilian reals per year. Applying the 4% rule, you would need an invested capital of about 3 million Brazilian reals. But what if you find assets that pay higher dividends? A well-structured portfolio can reduce this initial requirement, allowing you to live on passive income with a smaller capital. The secret lies in choosing the right assets, and that's exactly what we're going to explore now. An ideal portfolio for living off dividends must consist of assets with consistent history of payments and growing earnings. In Brazil, some of the best options are stocks from perennial sectors, such as electricity, banking, and sanitation. These companies operate in essential markets and tend to generate stable cash flow even during crises. In addition to stocks, real estate investment funds, FIIs, are an excellent alternative for those seeking monthly income, as they distribute almost all their profits to shareholders. With a balanced combination of stocks and FIIs, it's possible to build a diversified and resilient portfolio. Be careful. The biggest mistake an investor can make when seeking passive income is relying solely on the dividend yield, which is a percentage return on invested capital. Companies that pay very high dividends may be distributing more than they can sustainably afford in the long run, which can compromise their financial stability. That's why, besides dividend yield, it's essential to analyze the payout ratio, which indicates a percentage of profits distributed to shareholders. Healthy companies reinvest part of their earnings to keep growing, ensuring that dividends remain sustainable. After building your portfolio, the crucial moment arrives: defining your withdrawal strategy. This is where many investors fail. Some start withdrawing money too soon, without considering the impact of inflation and the need for reinvestment. Others, out of fear of spending, end up accumulating massive wealth without ever enjoying the benefits of their investments. The key is finding a balance between withdrawing dividends and growing your capital. If your portfolio pays an average dividend yield of 6% per year, for example, and you need 120,000 Brazilian reals annually to live, that means your assets should be around 2 million Brazilian reals. However, if that income is reinvested in the early years, your assets can grow much faster, ensuring a higher income in the future. The key is patience and knowing the right moment to start living exclusively on dividends. Now, let's talk about something most people ignore: how to protect your wealth over the years. After all, it's not enough to create a lifetime income if you don't take measures to ensure it isn't eroded by inflation, economic crises, or market changes. Let's now cover strategies to safeguard your money and make sure it lasts as long as possible. One of the most effective ways to protect yourself is by diversifying not just your portfolio's assets, but also its sectors and currencies. Investing abroad can be an excellent strategy because it allows you to benefit from more stable economies, such as the United States, and shield yourself from currency devaluation. Additionally, dollarized assets tend to be more resilient to local crises, providing greater stability for your passive income. Another crucial strategy is partial reinvestment of dividends. Many people make the mistake of withdrawing 100% of their earnings without considering that keeping a portion reinvested helps offset losses and ensures continuous portfolio growth. Studies show that investors who reinvest at least 25% of their dividends over the years significantly increase their passive income without needing to make additional contributions. And now, let's talk about the fatal mistakes that can ruin your plan to live off dividends. Many people believe that just buying stocks with good dividends is enough and that they don't need to do anything else. But the truth is that markets change, companies evolve, and if you don't keep track, you could end up with a portfolio that is no longer efficient. Another common mistake is spending more than the income allows, leading to withdrawals from principal capital, which compromises the entire long-term strategy. To avoid these mistakes, it's crucial to regularly monitor your investments. Create an annual review plan for your portfolio, assess whether the assets are still delivering good results, and, if necessary, reallocate resources to new opportunities. Most importantly, understand that living off dividends is not a magical promise of instant wealth, but a long-term strategy based on discipline and planning. If you follow the right plan, you can achieve financial freedom without ever worrying about money again. And now that you know exactly how to structure your portfolio and calculate your safe withdrawal rate, it's time to put this knowledge into practice. If you enjoyed this content, make sure to like the video and subscribe to the channel, because I always bring the best strategies to help you achieve financial independence. If you have any questions, leave a comment below and I'll respond. And if you want to dive deeper into this topic, watch the next video I'll leave on the screen. See you there.